Live from KUSI, this is Good Business San Diego. Sponsored by Wilsey Asset Management.
Hi, I'm Roy Roberts, Business San Diego, where we're talking about the topics that are important to you, your home, your family, your health, and your money. And the following is brought to you by Wilsey Asset Management. Well, we've seen setbacks in the stock market since the start of the war. Should you take advantage of lower prices and buy the dip? Brent Wilsey, president from Wilsey, joins us with his opinion here today. It sounds good in theory, right? Yeah, buy low and sell high and all that, but there's so much more to it.
There's so much more to it, and again, buy the dip has worked for probably like the last, we'll say 5-7 years. And people say, I've done great with the S&P 500, it's down, I'm gonna buy more. But they don't understand the value of what they're paying. And the S&P 500 is very expensive, and I'll give you more detail on that. But I want people to realize too that from March of 2000 to March 2010, the S&P 500 made no money at all. It was strictly zero, flat, nothing at all. So you got to realize that that can happen. And people look and saying, gee, I've done great with the S&P 500 again, 5 to 7 years. Well, that's a very short time frame because I look at the market over 100 years. And what's important is you look at, I always want to give people the fundamentals of what to understand, not just saying expensive just for no reason. We base on earnings. And you look at earnings right now, the S&P 500 is about 20 times forward earnings. And PE is price to earnings. And if you have a PE of 20, that means it would take 20 years to get back what you paid for the earnings of that company. Well, as I said, the PE right now is about 20 times earnings. That's about 20% above the 20-year average. So that's so when it pulls back, you're not getting a great deal. You're getting a lower price of a higher value. Also, too, we look at the price to cash flow. Now, cash flow is another indicator you look at to, again, show that the S&P 500 is expensive. And price to cash flow takes out depreciation and amortization. Well, the price to cash flow is now 27.3. That is 40% higher than the 20-year average. So these indicators show how expensive the markets are. So don't think just because it pulls back, you're getting something on sale. No, you're still paying a high price, just slightly less higher than before.
But the problem for most investors, myself included, is the fact that we don't have access to these analytics. We don't understand them. And so you can't oversimplify and just go, oh yeah, we're going to buy the dip, just because you need to understand all of this background, all this research that you do that goes into making these decisions.
And that's correct. I mean, people have to understand that investing is very complicated. People think it's easy. Oh, just buy the S&P 500 and you're fine. Yeah. Well, again, I'll go back to, again, that from March 2000, 2010, you made no money. That was not fine. And people get disenchanted, they leave, they come back, and I tell people, you want to be conservative. That doesn't mean you take all your money out of the market and you go to CDs or money markets. That's a completely wrong thing to do. But you find companies, you find equity stocks that aren't so expensive, because the S&P 500, I'm sorry, it's done very well, but it is very expensive.
One of the things that you've cautioned us about through the years is trying to time the market. And this is a great example of this, right? I mean, you just can't do this because you just don't know. Is the market at its low? Yeah. You know, it may be, it may not be.
Right. And the thing, too, we know you're supposed to buy low and sell high. Yeah. Well, you don't know where the low is. You don't know where the high is. So that's why you base everything on the fundamentals, because then you'll have a blueprint of what you're doing. And that's so important because it'll keep you on track. And people say, oh, you must be, you know, the market's down, you must be upset. No, I don't care. Because when we invest, we're buying these businesses, and they're not the exciting businesses. They're food companies, insurance companies. These are the companies that will do well for you long term. And I say if you average 10, 12% over a 5-10 year period, you're doing very well. People say, oh, I did 30% last year. I did much better. Yeah. That's 1 year. I try to tell people, too, if you are up 100%, and you lose 50%, you made no money for the whole time frame. So you got to be careful. You got to understand what you're paying for something.
Yeah, they probably feel really happy when you talk to them when they're up 30%. But when you have that conversation, they're down 30%, probably not getting the same reaction.
Not the same reaction. And again, they got to understand that they think they know a lot, but they know very little about a subject that's very complicated.
Bottom line, don't buy the dip just because there's a dip.
Exactly.
Don't be a dip. You'll find Brent online at smartinvesting2000.com for more information, and we'll be right back with more of Good Business San Diego.